I will at least get started now for everyone's time. It is 12:03. We're at 75 attendees, it looks like, or 66, including the panelists. But again, my name is Isaac Ellsworth. I am the VP of Sales at Republic Capital Access. Our motto is relationships over transactions. So not only do we love providing financial support for GovCons, but we love working with industry partners that can provide other solutions as well. So our colleague Matt Stavish had this great idea to bring on other industry partners to talk about the conditions we're all facing in 2023 in the credit market. And so we're just going to have James Middleton first share the market condition report, and we're going to hold all the questions till the end. So James Middleton, he's going to give us all 10 minutes to think of a market report, where everything's heading, what everything's looking at. So if you have any questions for James, feel free to put in the questions below, because we'll hold that to the end. And then I'm going to pass it on to our moderator, Michael Lopes from Bernstein, and he's going to host all our wonderful panelists, and I'll let him do the introductions there. So at this time, we'll have James Middleton from Strategic. He's a strategic advisor with Empower Financing and also a managing director at Proxima Capital, and he's going to give us our market conditions report. Pass it on to you, James.
Thanks, Isaac. Appreciate the opportunity to be here today and share some thoughts with you. I don't know if we can make that full screen, but let me just talk through it. In my previous lives, I was a strategy consultant for McKinsey, and so I can't do anything without PowerPoint. So we've got a handful of pages just to share some thoughts on how things are going. So, choppy environment may be a polite phrase for what we sometimes in venture capital talk about hodl hands of just hanging on for dear life. We have a lot of different headwinds and tailwinds, and so I've tried to highlight some of the things that I think are in some cases a little confounding, but the summary is just a lot of volatility, and maybe more than we have been used to. Overall, we have a low unemployment picture, but we've got some very sector-specific layoffs. Microsoft, the latest, to kind of join a very kind of unhappy bandwagon in tech and fintech, and still what I think is euphemistically the post-COVID structural changes to the workforce, where you have very, very spiky changes in labor, industry to industry, market to market. A couple of, I think, bright spots, surprisingly good consumer demand, maybe a little bit of an even Q4. I think that starts to change heading into 23, and we'll talk about some of the consumer dynamics as well. Inflation still unclear, but somewhat improving. And then the last three, again, kind of pick your trouble spot, but some domestic political uncertainty in terms of what happens with federal spending and the debt ceiling, ongoing geopolitical uncertainty, and some ongoing fallout from crypto, which is candidly more psychological than impacting on the capital front, but it does kind of fuel the psychology. Punchlines assume rates continue to rise, although as of this morning, the Fed is starting to spill its debate into public that the rate of change may be slowing. I'll stay away from too much calculus, but I think the punchline is we'll be in a higher rate environment, and then bank forecasts and outlooks continue to be revised. Almost as they come out, they're subject to revision. So I think against this backdrop of uncertainty, it's actually a very volatile environment, and in some cases, again, it's an industry of humans, and this may be the first true volatile environment that a lot of folks are working in, and sort of the era where low rates and steady growth were almost a guarantee and a given, I think is done. So some wisdom from the champ. Everyone has a plan, and until they get punched in the mouth. So how does this manifest a little closer to home? If we go to the next page, please. We talk about what are banks doing in their in changing their behavior. and how that approach is going to impact lending. And I'm really focusing here on the kind of the money center, the largest regional banks, to kind of understand the trend. But you have this, again, a little bit of a juxtaposition of a very good 22, although 22 didn't end as well as it started. But looking to 23, banks are facing a handful of headwinds just in their own operations. So in addition to this volatile environment, now we have a increase in loss reserves. So increase in loss reserves, obviously anticipating higher loss rates, but that also has a knock on to future lending decisions and capital allocations. Deposit funding, and this is part of the impact of that consumer rally, where driven by you could argue an artificially inflated savings rate, but consumers are switching, having depleted their savings to beginning to spend into debt. You have rising consumer losses, but the impact on the bank balance sheet from shrinking deposits means less of that kind of cheap deposit capital available. So this graph on the lower left, this is the Fed discount window. So when capital is plentiful, banks don't really need to go to the Fed for liquidity. Part of that is the Fed is sort of psychologically discouraged banks from borrowing from the Fed window, and even though during COVID, that giant spike you see in April of 20 was a relaxation of the discount window rules, both lengthening the time for discount loans and making them slightly less expensive. So you have that peak of roughly 50 billion, and then kind of goes back down to what looks like a normal through most of 21 and 22, and then you have this starting to tick up. So call it roughly 9 billion, which is 100 times normal. And so taking that sort of one pandemic outlier away, 100x normal discount window volume, what does that actually mean? Well, it means bank liquidity is under pressure, and the traditional sources that banks use are not delivering. So hence the pressure of deposits starts to ratchet into pressure on credit, and more wisdom for more people. This from Warren Buffett: when the tide goes out, you discover who's been swimming naked. And I think that starts to manifest itself as we go into 23. So turning to some implications, if we go to the next page. So we have this combination. We have the choppy environment, and we have what I'll call uncertain amounts of dry powder. So the lending capacity has been almost unlimited, but it's starting to see both some actual crimp, where the amount of deposits are falling, and some subjective constraints, where the old, again, this isn't a famous quote, but you get yelled at for not allocating capital, but you can get fired for driving losses too high. So banks and non-banks start to change what I'll call their lending thesis. This pressure for credit quality and higher scrutiny with an increasing role for subjective criteria. So subjective criteria is, call it lending heuristics, call it, sort of the eyeball test of different potential loans. But the simple fact is that experience is a tough teacher, and if things are gauged or judged as risky, especially heading into this environment, that is sometimes enough. So the punchline here is basically lower and slower. Getting capital allocated is going to take longer. It's going to be more difficult. The resulting decisions are going to be smaller and more expensive. So what it means is that capital strategy has to shift. So we go to the last page. This notion of a hybrid or flexible capital strategy. So, fans of Econ 101 will recognize these charts I've borrowed. These are overly simplistic view, but if that blue box on the left is sort of your traditional bank line, and that's where demand has met supply, the blue box is going to become smaller and more expensive. So on the right, the blue box is that smaller, more expensive, and the yellow has to be the supplemental, because despite the choppiness of the environment, demand for capital is same or greater. So trying to clear the same amount of supply requires this hybrid structure. So if you assume your core senior line is smaller and more expensive, you have to have a supplemental strategy. And that leads us to this, banks plus solution that some of us have talked about, and I know the panel will dig into, where you have to have a complementary or supplementary strategy to obtain the capital you're going to need in this market. So my final quote, which I discovered, is not actually from Phil Jackson, but from Heraclitus, that change is the only constant. I think those are probably a good watchword for the rest of 23. And hopefully this has been kind of a helpful table setter for the panel discussion. I'll be here at the end of the session if there's any specific questions I can answer them. And thanks again to RCA and the gang for putting this together. Appreciate the opportunity to share some thoughts with you today.
Thank you so much, James. That was excellent. And just as a reminder, we will take questions from the audience, so feel free to populate questions in the chat, and we'll be taking care of those with the last 10 minutes of our time together today on this webinar. But I just wanted to take a minute to thank James for an outstanding overview and for really setting the table for this discussion. I think James has basically given us the what and the why, and now it's incumbent upon us as the panel to show you, the audience, what you can do about it, because certainly we're in an environment of change. This notion of banking plus, words that James used like hybrid, flexible, that's very much represented in the people and the solutions that they bring to the credit markets in this panel. So looking forward to getting into that. A quick thank you to Republic Capital Access for having me, and a huge thank you to our panelists, which we will get around to having each of them make an introduction of themselves in a moment. But a quick hello from me first. So my name's Michael Lopes. I appreciate the quick introduction to Isaac. But I work with Bernstein Private Wealth Management. I lead our government contracting focused wealth management group here, where we focus on helping owners of government contracting businesses maximize and protect the wealth created by their businesses. 20-year veteran in financial services, with the last 10 being here at Bernstein. In case you're not familiar with my organization, I tend to describe us as a boutique independent money manager with global reach. We look after about $650 billion of client assets, which are under our care. About a little over 100 of that is on our private wealth platform. So, and again, a big thank you for being here today. So a lot of nuance to this topic. And again, we just want to make sure you know what resources are available to you to deal with this changing environment. So the way we're going to organize this, we're going to do sort of a part one here. And part one, we're going to think about sort of what solutions exist out of traditional banking source of financing, really to fund business operations. And part two, we're going to concentrate on more looking for credit solutions to help meet strategic initiative goals, fund growth, or do sort of balance sheet housekeeping, right? So to get started, I promised introductions to everybody. So we're going to do a quick around the horn. Everyone's going to give a quick background on them, their professional background and their organizations. And let's start with Matt.
Hey, good afternoon, everybody. Michael, thank you for the introduction. Thank you, everyone, for taking the time out of your day to join us. Matt Stavish, Public Capital Access. We're a member of the DoD Trusted Capital Marketplace and a largest kind of working capital solution receivables financing for government contractors in the country. This is my 9th year at RCA. We've been doing this for 13 years, funded a little over 1,000 different companies and 4,000 unique contracts, all in the working capital space for government contractors.
Excellent. Thank you, Matt. Tom?
Thank you, Michael. It's an honor to be here. GovCon Capital was created to serve the middle market companies operating in the government sector. We fund transactions for companies with revenues between $5 and $1.5 billion. Our specialty is aircraft and equipment financing and certain mission solutions. We've deployed capital in over 20 countries and over $100 million, and look forward to working with each of the panelists today to learn more about how we can help our clients.
Thank you, Tom. On to Paul.
Good afternoon, everyone. Thank you again, Michael. My name is Paul Schuldiner. I am the Chief Lending Officer of Rosenthal and Rosenthal. We're an 84-year-old family-owned and operated commercial finance company. We're one of the largest commercial finance companies privately held in the United States. Our specialty, most people know us as a factoring company in the what I would call non-government sector, so commercial, business to business. We factor about $10.5 billion of annual sales of our clients in the aggregate. We also provide asset-based lending. We international factoring for companies selling, exporters selling abroad, direct-to-consumer e-commerce inventory finance, and lastly, purchase order financing, which is a bridge capital tool, and going to be my area of focus today during our panel. Thank you.
Excellent. Thank you very much. Julie.
Thanks. Hi, my name is Julie Langdon. I am with Prudential Private Capital. I've been here about 10 years, and we are the private lending arm of Prudential Financial, the insurance company. We represent about $100 billion of the assets on Prudential's balance sheet, and we lend to a variety of companies in a couple different ways. That includes senior fixed rate long-term debt, senior floating rate debt, and junior capital, which is predominantly mezzanine debt, but also can include equity in a structure. So a couple of different things for companies.
Thanks so much, Julie. And Morgan Higgins, I got to say, about 9 out of 10 people on this webinar probably know you already, but just really quickly for everyone who don't, or for the few that don't.
For those that I don't know, it's nice to meet you, Michael. Thank you for the invitation. I'm Morgan Higgins. I am with Blue Delta Capital Partners. We make minority equity investments into government services companies to really help them grow. And so our focus is on being a partner in the business and helping companies think through their long-term strategic objectives, and always with a growth bent towards it. So appreciate the opportunity to be here. Look forward to the discussion.
Wonderful. Thank you. So let's transition into the questions we want to get to around funding business operations, right? So let's go to Matt. And Matt, can we just start, what are the circumstances a company might find themselves in where your solution effectively would be a good fit when they should think about you?
Sure. So we're brought in a lot of different situations. I'd say in the last 6 months, what we're being brought in is kind of two circumstances. The most interesting one, in getting off James's on the Bank Plus side, is we're being brought in adjacent to bank financing. And so because of a lot of the reasons that James delved into, you have a government contractor, they have 4 contracts, they win the 5th contract. That 5th contract is much bigger than the current contracts or the line can support. We're coming in adjacent to the bank to fund just that additional contract. So it really is bank plus RCA providing a total working capital solution for the company. And that really allows for facilitating quick growth and ramp up. It takes the pressure off of how do I get that working capital.
So, for government contractors, what should they keep in mind when thinking about getting an AR facility in place for 2023, being it is the beginning of the year and they can be looking proactively at this?
Yeah, I would say generally what we're seeing is certainty of capital is a big deal. So you need to make sure that you have access to capital that you need, but you need to be several steps ahead of when you think you're going to need it. If you're going to have a capital need on March 1st, you should be having conversations today. You should have term sheets from people today, be in underwriting today. Being ahead of it, it's going to take probably a little bit longer to close than you had been in the past, or maybe more scrutiny or questions with a hiccup maybe occurred in previous years. So being ahead of the curve and asking a lot of questions, and maybe you have to run a parallel path with, we're doing a couple of those right now where there's companies talking to banks and talking to RCA, and we're helping hedge those on either side.
So a little bit more of a little more complexity in the outlook for this year. So as you think about creating solutions for clients, what do you see for this year in terms of just overall structuring, creating bespoke solutions for each client?
I think really it used to be, I'm going to just need to get my bank line to fund this contract, or I just need this piece of capital to do this. And you may need different types of capital in order to execute from different lenders. I'm working on a deal now It includes us with an equipment lease finance company to help them buy equipment to execute on the contract, or maybe us plus a sub debt provider doing multiple finance companies or banks in the cap stack was only reserved for larger firms. And now that's coming down to even small businesses.
Interesting. I think one of the wonderful things about the government contracting industry is that one win could really change the complexion of a company. The challenge is that sometimes you have to wait a long time to get that win.
Yeah.
Government doesn't turn on the dime, but let's say it goes in the company's favor, right? And they're looking at something that really does, change the complexion of the business. How do you think about putting the capital in place to sort of meet the demands and challenges of that big win?
Yeah, so in the government services space, there's a really unique capital need that's different than some other businesses where you have a substantial payroll need prior to a receivable being generated. And, in the traditional markets, sometimes you'll see a bank lend against earned and unbilled receivables to help cover that payroll allocation, although it's getting less often that we see that. So it's really, can you make it through your first payroll to get to your receivables facility, if this at a bank or another institution, but how do you make those payrolls and then execute? And then really don't worry as much about the cost that you may have to pay for the capital, because at the end of the day, you need to make sure that you're executing on that contract. That's the biggest value to the company, is execution. You can always redo your cap stack 3 to 6 months in, but make sure you're able to execute and fulfill the mission. Yeah.
Excellent. Thank you, Matt. And just a reminder, anyone with questions for Matt, enter them into the chat and we will do our best to get to them in the balance of the time at the end of the panel. We'll have about 10 minutes for that. So with that, I'm going to transition over to Paul. It's helpful for Matt to set the table in terms of how his credit solution works, right? So if you can just tell me a little bit about how purchase order financing works for government contractors and how specifically that is helpful to have on tap in an environment like this.
Sure, absolutely. So purchase order financing, you have to think of it as sort of a bridge finance tool. So we get calls, we get referred in by banks, other finance companies, consultants, CPAs, trusted advisors, where their client has a fundamental need to be able to fund the purchase of the goods, whether that's raw materials or finished goods, in order to fulfill a large contract that they may have worked very hard to obtain. As you said, may take a year for some of these contracts or more to come to fruition. And now they have to produce. And all of a sudden, they thought they had the right amount of liquidity. They don't have the right amount of liquidity, and they're searching for other solutions. Really, purchase order financing, what it does, it mobilizes capital quickly in order to fund the purchase of goods, again, raw materials or finished goods, for companies that are typically in what I would call light manufacturing, assembly type businesses. It's really not designed to work for service-only companies. Therefore, there are other alternatives. Matt spoke a little bit about it previously, but it's designed for companies, again, more involved in manufacturing, light manufacturing, assembly, or distribution type businesses. So what comes into play is that the beauty of it is it can be implemented pretty quickly, and it works alongside other forms of financing. So it really is an alternative to company raising equity rather than replacing, debt.
So you kind of alluded to, there's nuance there in terms of the type of the business, like what kind of product or service being offered to the government, and that impacts how you might look at it. But can you tell us a little bit more about how you approach the underlying business in terms of underwriting those deals?
Sure. So when you're looking at a distribution business that typically really revolves around companies that are outsourcing their manufacturing in some way, shape, or form. In the government sector, it would be unusual for them to outsource to a foreign manufacturer typically, but they may have to get certain componentry that might be needed to make the product. In a distribution business for government, it may be they're using a contract manufacturer located here in the United States. And usually what happens is there's unavailable credit for the client who's got this large contract in order to be able to buy those typically now finished goods or nearly finished goods. So when we underwrite those transactions, those are typically a little bit easier to underwrite because we are buying finished or nearly finished goods on behalf of our client. We can get our hands around those goods quicker. Conversely, if a company is what I call full production, manufacturing their own facility, then we're really involved in taking a deep dive into the bill of material of that client and looking at how many vendors, how many parts, how many components, how long does it take to make. We like things that are made probably in a 90-day cycle, that the product is made and then is shipped out to the government entity that's buying it. Things that's going to take more than 120, 180 days. That's what we call heavy duty manufacturing. Those are a little bit more difficult deals to underwrite.
So in terms of from diligence to funding, what's the time horizon look like in each of the categories?
Sure. I would say for the finished goods deals, typically we can be in place usually within 10 days, including an intercreditor agreement, depending on, and again, with an intercreditor agreement, if I've worked with like a partner, like we've teamed up with RCA before, where we have an established intercreditor agreement, it works very quickly. If it's a bank or other finance company, it takes a little bit more time maybe to get through the intercreditor agreement if it's the first time. Production deal, I would tell you probably is closer to 4 weeks, I would say, because the underwriting is much more involved in terms of having to really look at the cash flow of the company. What we really want to be finding is that we're financing an incremental revenue opportunity for that company, meaning that contract that they've gotten from a governmental agency. If they need that funding in order to first kind of come out of a turnaround, that's a little more difficult underwriting. So again, it takes a little bit longer in that 4-week span from beginning to end, I would say.
I think you made reference to intercreditor agreement. So it's sort of in the senior portion of the capital stack. How do you play with the other providers of senior financing?
Sure. So it assumes for this discussion that if there's an existing senior lender that's already in place, that they have a first lien on all assets of the company, other than maybe equipment. There might be an equipment lender who has a carve out for a specific equipment financing. But assuming that the working capital lender has a first lien on all assets of the company, the intercreditor agreement is designed to carve out the contract that we're talking about and basically what's involved in order to create tangible collateral, meaning you've got a contract, which is a nice piece of paper, which is an opportunity that somebody can be very successful, but there's no assets yet created. So we're going to create the inventory and ultimately turn it into a receivable. So we carve that contract and everything that relates to that contract out through an intercreditor. So I have a first lien on that, any collateral created with respect to that contract. Everything else stands right now consistently with that senior lender. And then when it turns into a receivable, the intercreditor agreement provides for a handoff to whoever is providing the accounts receivable financing now, because now you have an actual receivable due from the government. And that's the handoff. We get paid at that point typically by whoever's doing the AR financing, and then my lien is terminated.
Wonderful. So we've covered the AR financing, factoring, looking at purchase order financing. Tom, let's pivot to you. Why don't you tell us a little bit about the credit solution your company offers?
Sure. What we look at is what way in which we can most effectively manage a government contract and structure it. We structure each transaction to meet specific mission requirements of the contract. The unique thing about government contracting is every contract has special provisions, delivery schedules, vendor payment obligations, and benchmarks that need to be met. And whether you're financing an aircraft, an equipment, or mission systems funding. And so what we do is take time to collaborate with the client finance team and stakeholders. One thing that we really look at, and I think it's probably a priority for each of the panelists and their organizations, is we really look at how we can take every transaction and create a transaction where we believe the client is going to have maximum cash flow. That essentially means that let's make sure they get the lowest payment and the biggest delta between what the government is paying them and what they're paying us. So essentially what we do that makes us a little unique, we take large residual positions in equipment, and it really benefits both the customer and the contract.
So what's the most effective manner that a government contractor can structure an equipment transaction?
Well, I think, each is a little different. I think when you look at a typical contractor, they want to make sure they have contracting on unique assets, whether that's an air asset, a mission system. There's different components, different integration parts that actually, move into our part of the funding. Because we only take UCCs, we're really able to complement what banks provide. And really what it allows us to do is, and we work with companies like RCA all the time. The good thing about equipment financing is you can really complement both the AR financing and the bank financing in a way where really the client benefits.
Got it. And so from a timing perspective, I think one of the things that we're trying to convey here is the value in being proactive and understanding what options are out there, because more than likely you'll find yourself as an operator of a business in a situation where what's worked for the last several years is not going to, and you need to have this hybrid approach, right? So for folks that are thinking about engaging, what kind of a lead time would you recommend people operate with an understanding of?
Well, I think as soon as the contract is awarded, the contractor should reach out to GovCon Capital as part of their lending group as soon as possible for three reasons. First, with interest rates being what they are today, a little unstable, hopefully they're going to become more consistent. But locking in a fixed rate can save the client a significant amount of money and interest expense over the term of the lease, even through the appeals process. Another key component is that the assets that comprise the mission solution and the primary contract property can be delayed up to 25 weeks because of supply chain issues. So you can't really wait until you get through the appeals process, because then you're going to be subject to the delays on the supply chain. So what we recommend is having the right funding in place, which allows the clients to be in a stronger purchasing position and not have any delays. And I think the third reason is contractors really need to make sure that as soon as the appeal process is complete, that's when those first task orders start to occur. And when task orders are delayed, and that means revenue's delayed. And when revenue's delayed, the presentation of the financials, both on a P&L standpoint and a balance sheet standpoint, really takes the contract off course. And so seeking approvals immediately can really help a better flow of the contract process.
Since we're talking about equipment financing, how do you think about the location of the assets you're funding against? How does that factor into the solution you put together for a client?
Well, I think it makes a significant difference. One thing that differentiates GovCon Capital from many of its competitors is we're able to fund assets CONUS and OCONUS. The reality is today's government contractors, especially in the A&D space, they're global companies. They have international revenue, commercial revenue, and federal revenue. And for them to have the ability to finance 100% of their equipment and 100% of their deployed assets, especially in a tight credit market, really allows the contractors to have the most financial flexibility. And the one thing that's needed today is that flexibility. The other is that contracts overseas can be much more expensive than a contract here in the States. So obviously you want the greatest return on your CapEx, and really being able to finance CONUS and OCONUS is really what our clients appreciated, and certainly what we look forward to providing.
Excellent. Very helpful. Thank you, Tom.
Thank you.
We're going to switch gears now and go in the direction of talking about funding strategic initiatives, growth, for example, acquisitions, and general sort of tending to the balance sheet. And for that, we're going to pivot to Julie Langdon. And Julie, if you could just tell us a little bit about what a non-bank lender is, or other buzzwords you hear, such as private credit?
Well, I think the name of non-bank lender kind of points out the first key difference, which is as a non-bank lender, you're not regulated like a bank. And as James pointed out in his slides, there's certain elements of just how a bank does business and how that impacts its ability to lend that can influence then their, how they act in any particular part of a credit cycle. And as an insurance company, we're regulated by insurance regulators, and it means we don't have the same limitations from a leverage perspective, from a deposit base and appetite perspective. And then also just as we take a long-term perspective, we're used to, a premium being something that, might be a liability 30 years from now. And so we do the same thing in lending. We're looking at, investing in a company, and no matter the actual duration of the loan, we're thinking about that over a 10+ year time frame. And that allows us to just be supportive of businesses because we're thinking through a cycle instead of being surprised, you only looked at something for 2 or 3 years and now, suddenly an environment like this hit and we weren't prepared for that.
So just a quick question here, and that is, are you seeing an uptick in demand for your solution in the current environment?
Yeah, so as I mentioned at the opening, I do deploy a couple different pieces of capital. And so which one is in most demand, does ebb and flow. And right now, I would say mezzanine debt is very much in demand. That was quite out of favor given the strong senior bank appetite that existed, or just senior debt appetite that existed in the last couple of years. And now that valuations have continued to stay high, but senior debt appetite has retreated, both in the commercial bank space and even somewhat in the traditional private lending or private credit space. We're starting to get requests to fill that in with mezzanine debt. So that's pretty popular. I like to say also it's getting relatively cheaper every day because pricing for that hasn't really moved. But in the senior floating rate market, with SOFR, increasing, that's gotten quite expensive. Having said that, I would say the second demand we see is in the senior floating rate. And that, again, is because it's answering what can't be filled in the commercial banking market. And companies are still trying to stretch leverage, as much as they can, again, to achieve their goals.
Yeah. And so as you've described yourself as a generalist, and this is a GovCon focused conversation. What makes you a particularly good fit for government contractors? Because it seems that there is a strong case to be made there.
Yeah, I would say we're not going to be a great fit for every government contractor. I think over any company's life cycle, there's different financial partners that make sense. And so that's why it is great to have kind of a lineup like is on this panel, because needs are going to ebb and flow. But for GovCon companies that are larger, more diversified, that are looking for some sort of episodic needs, so we tend to finance more of, acquisitions, shareholder transitions, that sort of thing. We can be a great answer for that. And then, the other thing is we generally come at things with a fixed rate perspective, and that can be really great in an environment where you're on a fixed rate contract. So matching that fixed rate debt with fixed rate gross profit, avoids any surprises then for the company.
Yeah, thank you. And friendly reminder to the audience that if you have any questions for Julie, enter them into the chat, and we'll make sure that we do our best to get to them for the time we withheld for questions. But now we're going to pivot a little bit. And Morgan brings a pretty unique perspective here. So as a banker at one point in your career, a very successful one, and then moving over to the private equity side of the house, when you're speaking to your portfolio company boards, what kind of conversations are you having with them around leverage?
No, it's a great question. It's nice to be the reformed banker and sole equity provider on the call, but Look, I think we talk a lot about what is the appropriate amount of leverage for your business. And from a government contracting standpoint, I think we're seeing a couple of things in the overall broader economic market and that sort of the macro environment. And it's really, we're talking to our companies about what does their pipeline look like? What are those growth prospects? And we're seeing a big shift to the right of contracts. It's taking contracting offices longer to get contracts awarded, adjudicated, and thus for those companies to start. And so I think, something that may have taken 100 days in the past is taking, can take up to 6 months, in some cases longer than that. And so I think when companies think about their leverage and sort of the cash flows that would be the ability to repay that leverage, it really is making sure you're thinking through the macro environment. I think the other thing that James touched on is really the rising interest rate environment and how quickly is that going up. And so that's another thing that we consistently talk about around leverage is that with floating rate debt, your leverage will ebb and flow based on what those interest payments look like. And depending on, the cash flows of the businesses, you want to be sure you've got your eye on the rising interest rate. And I think the other thing is a little bit more of an intrinsic. Has your business ever operated with leverage on it before? So does the management team know and understand what it's like to have to meet covenants every quarter? And are they used to managing the business in that regard? So a lot of businesses that we talk to, if there's a procurement that's coming out or there's an investment that they want to make, they make that investment. They go after that next big contract. And in a leveraged environment, you may not have the ability to sort of lean forward from an investment standpoint. And so I think trying to think through intrinsically kind of what level of leverage are you comfortable with? Just because a bank says or a private lender says that you can afford it, it's sort of like a house. Is that where you can best optimize your business? And are you comfortable at that level?
Yeah. I mean, just in general, are you preaching sort of a cautionary sort of posture right now to those folks, just making a broad generalization? Or are you still seeing?
I think it's, look, if it makes strategic sense for the business and it's something that is going to help you get to that next level, I think we're bullish, right? I think there's absolutely a place for leverage within businesses, and especially in the government contracting community where we do have some recession resistant characteristics driven by those kind of predictable cash flows. But I do think it's, every business is different. Every business and the stage that it's at in the life cycle is different. And so I think it's always helpful to think through, do you have a lot of recompetes coming up in the next year? Do you have some big pursuits that you want to go after and maybe back off the total amount of leverage because you want to give yourself some flexibility on the working capital side?
So, thinking about in the context of doing like a recap or acquisition. So how do you think about sort of the spectrum of capital solutions available, both for doing the recap or the acquisition, or the working capital needs of the organization going forward? How do you think about that?
Yeah, I think, well, on the one end of the spectrum is senior bank debt, and that is the cheapest form of capital. It is the most restrictive from a covenant perspective, and but it can be very advantageous from a cost perspective. I think on the other side of the spectrum is sort of that buyout private equity. You sell control of your business, and you've got a whole bunch of folks in between with varying levels with debt and equity and different offerings. I think it's smart always to think about who are you partnering with? Who are those advisors? And we tell our companies, spend as much time interviewing us as we're interviewing you. And I would say that's across the board from a capital perspective. Make sure that you have a partner in the business, because I think, everything's great when it's working. And unfortunately, when you hit a bump in the road, sometimes you really determine who those partners are. And but we look at all different aspects from a capital perspective and capital spectrum. And many of our companies do have debt on them if they're facilitating things like a recap or an M&A transaction. And our hope is that, we help them and we've got good partners on the other side of the table.
So we have a couple minutes here to throw in an additional question for you, and that is, how are you thinking about, as you're looking for companies to invest in. How are you thinking about valuation, given what we're seeing in the credit markets?
So we're very fortunate that we tend to not over-lever our companies. So we look a little bit different than a traditional private equity firm that comes in, and generally you have a debt facility that sits alongside of the buyout shop and their equity that goes alongside of it. So I think we've got the ability to be flexible. Most of our companies are utilizing their debt capacity and dry powder for the M&A scenario where, hey, we've got to have this customer, this capability, this contract vehicle. And so we're fortunate from that regard that we're not as disrupted from a valuation perspective, but we tend to take the longer term view of, hey, what is this business going to be worth in a few years? How quickly can we grow it? What are the adjacent markets? How strong is the customer intimacy? And on the back end, who has to own it? Is it another private equity sponsor? Is it, the founders want to recap and take us out? Or is it a strategic that really is, attracted to the business based on the capability or the customer intimacy? So we spend a lot of time on valuation. I think, it's been an interesting time. And I do think the credit markets have certainly, there's some volatility from a multiple perspective, but, we'll see. I still think 23 is going to be a busy year.
Yeah. And it's really helpful to get sort of the owner operator perspective on things. But just to mention for the audience, in case it's not abundantly obvious, that, growth equity is another solution that's available to you if you need capital for the business. There's got to be strategic alignment in taking it on, right? There's circumstances that need to be present, but by all means, this is another sort of tool that can go into the toolbox when looking at the strategic direction you want to take your companies in and figure out how to finance it, ultimately increase your chance for success. So that brings us right up neatly to the 12:50 mark, which is when we were hoping to start the Q&A. So a quick reminder that anybody has any questions, go ahead and enter them in the chat and those will get fed to me. And I'll just start with the first question we have here. I'm just going to read it right from the chat. So would love to hear some strategies specifically targeted companies in R&D product pre-manufacturing with a bullet point. Matt and Paul or Tom, this would be right up your alley. So did one of the three of you want to raise your hand for this one?
I'll take the first stab at that one.
Yeah.
The nature of the R&D contract would be kind of interesting to hear how easily fundable it is. If it's a R&D contract that is tied maybe an OTA or a SIBR vehicle that has some milestones built in as you lead up to the manufacturing design process, that's significantly easier from our perspective of funding the receivables, an easier buildup. And then quickly from there, it digresses into probably Paul Schuldiner's world of like, what do you need to manufacture to create the final product? Those are, depending on the milestones and the deliverables before you get to the end product, does kind of dictate the complexity required to finance those sort of deals in my experience.
Paul, did you want to add to that?
Yeah, I'll jump in. So, in our traditional world, if something's usually not out of proof of concept, that kind of gives us, typically, I would say usually will give us pause in the commercial, certainly in the commercial sector. In the government situation, I think Matt hit it on the head. We'd have to really work with, like, let's say somebody like Matt to understand the intricacies of the milestones and what's involved. And it comes down to really our belief and faith in two things: the company's ability to execute, to get there, and our belief in the product, and our belief in the ability of somebody like Matt to take us out when a receivable is being created, whether it's milestone related or not. Those are the factors that go involved in something like that.
Tom, anything to add?
Sure, I think Paul and Matt, hit a home run on that. I mean, the reality is, some of these SIBR contracts are becoming more and more mature and more easier to finance. But the reality is, oftentimes, even though you have great collateral and great equipment and property, the realities are it's the cash flow in versus the benchmarks, and to be able to get clean and good revenue on a consistent basis through multiple CIBR contracts and R&D contracts. That's really at the end of the day is going to what drives success.
Excellent. Anybody else with anything to add to that? I think we're good. All right, so James, based on the comments you made in the beginning, James, just a reminder, you might want to come off of mute. There we go. Do you expect leverage multiples to change much in the next year? And if so, by how much? This is one of those crystal ball questions you knew was going to happen.
Oh, sure. Well, I mean, so simple answer, yes, because the amount, and I'm assuming the question's oriented on how much leverage the borrower will be able to take, and so that's going to have to come down because it's a conservative lending decision. So the issue is that when you look at the sort of the sunny day scenario in issuing credit is everything's great and you can have an infinite amount of leverage because the business can support that and everything turns out well. In the doomsday version, you're going to go back to the core collateral value that you're levering, and in a tightening environment that has to fall. Whether it falls by a third, a half, I think is going to depend on the circumstances, the industry, the market. Kind of pick your flavor. But I think this is going to be, maybe 1 or 2 sigma more than a traditional tightening, just because of all of the auxiliary factors that are very hard to quantify. So that's my unsatisfying forecast answer. But
thank you. And I got another question for you, James, and that is, not all banks are created equal, right? So when you think about the locals, to the regionals, to the nationals, are you seeing a pullback across the board? Do you see certain banks are going to behave differently in this environment?
Yeah, I mean, so the difference between those banks is not just the number of zeros. I mean, the drivers here are essentially the reliance of the bank on organic deposits is relatively static. I think after you get past kind of the top 25 or 30, it becomes more homogenous in that among the larger banks there are some different capital strategies, but everyone is going to essentially take the same strategy, which is liquidity is tightening, rates are rising. I can't rely on deposits as much because in a broad sense, the consumer has stopped saving and started spending. Yeah. Both my consumer and my commercial book are going to brown out and worsen. So therefore, right. So I think the punchline is the same. I think it's a matter of the nuances between the larger and smaller banks are going to be driven more by their individual liquidity positions. And to some extent, how conservative their DNA is. Different banks have different heritage around lending and kind of how they approach the sort of the qualitative factors in credit and capital decisions. So that might come to bear as well.
Yeah, I think we have time for, thank you, James, very much. I'll give a moment for one more question before wrapping it up here. We have one more coming in. Okay, so this will be the last question. What is a common mistake GovCons make in terms of exit strategy? Who wants to take that on? I'm going to say that to Morgan, actually.
Yeah, I'm happy to jump in there. I would say the biggest mistake that we make is a company not having a clear strategy and primarily driven by, they take whatever contracts they can get. They don't necessarily have a targeted portfolio of work. And thus, when it comes to an exit, they're not super attractive to any one buyer because they've got such a variety of contracts or customers. And so I think having a clear and concise strategy is really important. Not saying that you're not opportunistic on contract wins and all of that. And, you know, we do advise our companies, hey, if this is going to give you past performance to bid on something that is within your strategy, make sure you're always considering those, you know, 1 and 2 step moves. But I think that's the biggest thing that we see is that not having a clear strategy driven by a customer or capability portfolio really limits the buyer universe.
Yeah, and I think things proactively owners can do is get involved in the M&A community, because you can have conversations and develop relationships with professionals that are dealing with transacting with this industry all the time. They understand what the levers of value are. They've sat with enough management teams to know where the pitfalls are and things to avoid. So check out things like the Professional Services Council if you're not already. Association for Corporate Growth's National Capital Region has a wonderful community of GovCon and advisors that are very much well versed in that industry as well. And it's just about having communication with the experts along the way as you think about plotting the strategic path of the business. Just to close, I'd like to thank again Republic Capital Access for having all of us here today. James Mendelson, thanks so much for providing us with the overview and for setting the table. And to each panelist, thank you for taking time to share your knowledge and expertise with the group. You know, for the stakeholders that we might find on this, right, whether it's a banker, everybody here is a potential resource for you as you think about shepherding resources to your clients in this environment. Because at the end of the day, great bankers are just worried about one thing, and that is making sure the clients get what they need. And so there's tremendous amount of value there. If we have members of the accounting, investment banking, legal community, folks who see themselves like I do as a holistic advisor or a strategic problem solver for owners of government contracting businesses, everyone here is a valuable resource for you going forward. So I encourage you to reach out via LinkedIn and keep the conversation going. But thank you so much for being here today, and hope to see everyone at some point soon. All right, take care. Thank you.
Thank you, Michael.
Thanks, everybody.
Thank you.
Take care.